For those new to the Canadian tax system, it can be confusing to differentiate between tax deductions, tax exemptions, and tax credits. These terms often sound similar, but serve different purposes in reducing your overall tax burden. Understanding these differences is crucial for effective financial planning and ensuring you take full advantage of the tax benefits available to you. This guide provides a detailed explanation of each term, along with examples, including various types of accounts like the First Home Savings Account, FHSA, Registered Retirement Savings Plan, RRSP, and more to illustrate how they work in the Canadian context. 1. Tax deduction. A tax deduction reduces the amount of income subject to tax. It lowers your taxable income, which in turn reduces the amount of tax you owe. Deductions are typically related to specific expenses that you incur, such as medical expenses, charitable donations, or contributions to retirement savings plans. Example, Registered Retirement Savings Plan, RRSP contributions. In Canada, contributions to an RRSP are tax deductible. For instance, if your income for the year is 50,000 Canadian dollars and you contribute 5,000 Canadian dollars to your RRSP, your taxable income becomes 45,000 Canadian dollars. This reduction in taxable income lowers the amount of tax you owe, helping you save money while also planning for retirement. Example, First Home Savings Account. The First Home Savings Account, FHSA, is designed to help Canadians save for their first home. Contributions to an FHSA are tax deductible, similar to an RRSP. If you contribute 8,000 Canadian dollars to your FHSA in a year where your income is 60,000 Canadian dollars, your taxable income would be reduced to 52,000 Canadian dollars. This deduction not only helps in saving for a home, but also reduces the overall tax burden. 2. Tax exemption. A tax exemption is an amount that can be deducted from your gross income, often resulting in a portion of your income being completely excluded from taxation. Exemptions are typically more categorical, meaning they apply to specific types of income or certain categories of taxpayers. Example, Basic Personal Amount, BPA. The Basic Personal Amount is a common tax exemption available to all Canadian taxpayers. It allows individuals to earn a certain amount of income tax-free. For the 2023 tax year, this amount is 15,000 Canadian dollars. If your income for the year is 35,000 Canadian dollars, the first 15,000 Canadian dollars are exempt from federal income tax. This exemption effectively means you only pay taxes on the remaining 20,000 Canadian dollars. Example, Tax-Free Savings Account, TFSA. Income earned within a tax-free savings account, TFSA, whether from interest, dividends, or capital gains, is exempt from taxes. For example, if you invest 10,000 Canadian dollars in a TFSA and it grows to 12,000 Canadian dollars over the year, the 2,000 Canadian dollars of growth is tax exempt. This exemption allows for significant tax-free wealth accumulation over time. Tax credit. A tax credit directly reduces the amount of tax you owe rather than reducing your taxable income. Credits can be either refundable or non-refundable. Refundable credits can result in a refund if the credit exceeds the amount of tax owed, while non-refundable credits can only reduce the tax liability to zero but not below. Example, Canada Child Benefit, CCB. The Canada Child Benefit is a refundable tax credit provided to families with children under 18 years of age. For example, a family with 2 children may receive a CCB payment based on their household income. If the family's calculated tax liability for the year is 3,000 Canadian dollars, but they are eligible for 4,000 Canadian dollars in CCB, they would receive a refund of 1,000 Canadian dollars. Even if they have no other tax liabilities. This direct financial support helps cover child-related expenses and is particularly beneficial for low to moderate income families. Example, Home Accessibility Tax Credit. The Home Accessibility Tax Credit is a non-refundable credit that helps cover the cost of making homes more accessible for seniors and persons with disabilities. If a homeowner spends 10,000 Canadian dollars on eligible renovations to make their home more accessible, they can claim a credit of up to 15% of these expenses, reducing their tax liability by 1,500 Canadian dollars. This credit encourages necessary home modifications that can improve quality of life. Example, Climate Action Incentive. This refundable tax credit is available to residents of provinces that do not meet federal climate pricing standards. The amount varies based on the province and family situation. For instance, a family in Alberta might receive a climate action incentive payment of 600 Canadian dollars, which reduces their overall tax bill and encourages environmentally friendly behaviors. Conclusion. Understanding the differences between tax deductions, tax exemptions, and tax credits is crucial for maximizing your tax benefits in Canada. Tax deductions reduce your taxable income, tax exemptions exclude specific types of income from being taxed, and tax credits directly reduce the amount of tax you owe. Accounts like RRSPs, FHSAs, and TFSAs offer unique tax benefits that can further reduce your tax burden. By effectively utilizing these tools, you can manage your tax liability more efficiently and potentially increase your financial savings. Consulting with a tax professional or using reliable tax preparation software can help ensure that you are taking full advantage of all available tax benefits.